This is Fintech Insider News. This week, Stripe and Advent reportedly make a bid for PayPal. Buy now, pay later enters a new regulatory era in the UK. Nubank receives banking authorisation in Mexico. And a Sumsub survey shows how AI is changing the fraud landscape. We'll be tackling all of this and more on today's news show.
Choice Hotels get you more of what you value. Here's a little tune to help you remember. Same drive, different day. Don't you wish you were getting away? Pack your bags and come on through. Texas, Ohio, Alaska, we're up there too. Comfort Inn, it's calling your name. Save on the stay. Oh, and free waffles are yours to claim. Well, I hope you like my little song. Book direct at choicehotels.com.
Hello and welcome to episode 1082 of Fintech Insider News, brought to you by 11FS, the six-time consultancy of the year that works with financial providers big and small to build the next generation of financial services. I'm Benjamin Ensor, Director of Research and Strategy here at 11FS. To help me unpack the biggest and most interesting stories from fintech and financial services from the past week, I'm joined by a brilliant panel of three guests. First of all, we have a welcome back to the podcast for Alex Marsh, Chief Executive at Salad Group. Hello, Alex. Please can you introduce yourself to our listeners and tell those of you who don't know a little bit about Salad Group?
Hi, Benjamin. It's great to be back. So yes, I'm the CEO of Salad Group. We are on a mission to modernise consumer credit in the UK. So we're a UK fintech, particularly known for our Salad personal loans business, where we use open banking data to enable real-time assessment of consumers' affordability, hence providing access where potentially they're locked out of mainstream financial services. Very proud to say last week one of our team met the King, as we were presented with a King's Award actually for innovation in relation to our underwriting approach, which is very cool. And that's reflected then also in over 15,000 Trustpilot 5-star scores. Prior to that though, very proud to say I spent 5 years at Klarna, including as UK CEO. So really excited to get a chance today to talk a bit more about what's happening in that sector in terms of regulation.
Thank you, Alex. Sounds fantastic. I'm envious of your team members who got to meet the King. Congratulations. Okay, and we also have a welcome to the show for Danielle Labarbera, Vice President of North America at Sumsub. Welcome to the podcast. Can you introduce yourself and Sumsub, please?
Absolutely. Thank you, Benjamin. Thrilled to be here. As you mentioned, I am privileged to lead the North American business development team at Sumsub, and we are a full cycle verification and fraud prevention platform. So what that actually means in practice is we help companies, exchanges, wallets, fintechs make sure that they're onboarding real users, not fraudsters, and that they're doing it in a way that meets regulations and requirements globally. We have over 4,000 clients. We work with customers such as Duolingo, Vodafone, Bybit. It's a really exciting place to work. Thank you for having me.
Fantastic. Thank you for joining us. And I'm also delighted to welcome to the show Alberto Lazarov, co-founder of Dalatea. Alberto, welcome to the show. Please, could you also introduce yourself and Dalatea to our listeners?
Hi, everyone. My name is Alberto, CEO at Dalatea, and we help banks automate internal risk processes in Europe. With one goal in mind, we help them make more money. More specifically, we help them reassess the risk for their contracts and lower down the provisions they have to keep. We help medium-sized banks and also any other financial entity that gives out credit.
Fabulous. Well, welcome. Okay, well, let's get started. Our first story is that Stripe and Advent International have reportedly made a bid for PayPal. So this is one of the biggest stories, which comes from the States, where Reuters reports that Stripe and private equity firm Advent International have made a joint offer to acquire PayPal in a deal that's reportedly worth more than $53 billion. According to Reuters, the offer values PayPal at around a 28% premium to its previous closing share price. Neither Stripe nor PayPal nor Advent has commented publicly on the report. So at this stage, it remains a little bit unconfirmed. Alex, how big a story do you think this is? Is this a big deal? Have people been waiting for PayPal to be taken over, do you think? I mean, like PayPal's like the old guard, the original fintech.
Yeah, I mean, it's a big story, I think, in the sense of, like you say, PayPal, they were seen as sort of the original fintech disruptor, if we go back 15 years. And it shows a sort of a shift in position, I'd say, between the two businesses, because, again, even rewind 10 years ago, PayPal relative to Stripe, you would have seen PayPal as the sort of powerhouse here. I think it shows the progress that kind of Stripe have made and how they've reached similar places between the two businesses from different starting points. So PayPal very much as that consumer brand, but then have sought to expand out and have a more sort of infrastructure role as well. And then, similarly, Stripe, actually, they started at the other end of the spectrum as very much, infrastructure developer first, infrastructure working with retailers and other e-commerce sites, but then actually that move across into the consumer-facing side more so recently. So it's an exciting one. It's a big one, like absolutely huge if this, it does progress. Now, we could come on to it, but I think it highlights some of the challenges that, PayPal have faced and, the potential symptoms you see of that in terms of changes at the top, challenges around cost base, challenges with growth, and what that can then lead to.
Yeah, you're right. I mean, PayPal has definitely been navigating a number of challenges. It's interesting that you say the way you sort of said, they've sort of the two companies sort of converged, because I maybe in my head and maybe a bit simplistically, I sort of see PayPal as sort of to some extent serving consumers and Stripe to some extent serving businesses. But of course, payments are often between consumers and businesses, so that's a bit simplistic. Alberto, I'd love to bring you in. Do you see PayPal and Stripe as sort of quite different businesses, of having different business models, or do you sort of agree with what Alex sort of half said, that they're sort of converging over time?
I think they're converging over time and that they have kind of similar business model. The key here is owning the customer, right? And I think the end customer, and I think that's what Stripe is trying to achieve here. PayPal would give them a huge distribution network with Venmo, I don't know, with 400 million users with a downloaded app on their phone, and a huge brand with an associated trust. So I think that's what they're after.
Yeah, that makes sense. So the play here for Stripe is really acquiring those hundreds of millions of users that PayPal has, rather than perhaps the underlying technology. Do you agree with that, Alex, that it may be as much about the relationships as that PayPal has, the customers it has, rather than necessarily PayPal's capabilities? I mean, obviously this is speculative.
Yeah. I mean, I think I've got such mixed feelings about, PayPal, and not getting sort of too bogged down with PayPal specifically as part of this, side of it. But it's an organization that, again, rewind sort of 10, 15 years ago, it felt like so innovative in terms of what it was doing, the disruption in terms of, the payment rails that were so well established with MasterCard, Visa, and then to end up in a position where it's got that, it's almost hygiene factor that it's within checkouts. And, to Alberto's point, built then and amassed an absolutely huge global consumer base. I think there's sort of the counter challenge as a business, and why it's, ending up, I think, that, even this kind of option of sort of, merger consolidation is out there, is because as users, do we feel excited about using PayPal? Do we feel like it's innovated, from as much a user experience? And has it sort of garnered, I suppose, that loyalty where it's more than just, a functional role in the way that, broadband is to, enabling access, to, services? Is it sort of, has it become almost a hygiene level sort of functional player? And I think it does play then to the reach, but I think there is an opportunity there with the right partner that you could reinvigorate that excitement as an ecosystem and as a tool. And it's not there, I'd say, at the moment in terms of sort of user interface or, breadth. They've tried to broaden the offer, but I still don't think it drives the level of excitement like you see with the likes of, other disruptors more recently, like Revolut and others. Monzo.
I have to admit, I've sort of sometimes forget that so many people still use PayPal. And part of the reason for that is I got locked out of my PayPal account 5-6 years ago because the two-factor authentication never worked. I just never received it. And contacting PayPal is impossible if you're locked out of your account. So you get caught in this sort of vicious circle where you're locked out and you can't get back in and you can't contact them and you sort of eventually just give up. I suspect I've been unusual in having that kind of user experience, but sometimes it sort of comes to your point about that sort of loss of innovation. Danielle, what's your view on this story? Do you use PayPal? Do you think this is a potentially significant deal? What's your take on this?
Absolutely. I do still use PayPal, but I have to admit a lot less than I used to. And I think if you think back to a decade ago, it was a real innovator within the marketplace, particularly when they surged ahead with PayPal Credit. And they were one of the leaders, I believe, in buy now, pay later and the opportunity to split up payments. I'm very excited to see what this potential merge does for the end customer user. I think this could be really, really interesting. And what Alex was saying about expanding the customer reach to take PayPal from what I believe now is a pretty established payment method that we don't consider as an innovator and a disruptor right now. And to see what this merge does, I think there's going to be some very exciting product developments on their roadmap in the next 12 to 18 months.
I was interested in what you were saying, Alex, about developers, because Stripe's always been the sort of the poster child of how to design for developers, how to make things easy for developers. And if Stripe manages to firstly buy PayPal and then sort of turn the customer experience of PayPal around and bring back some of that innovation, that's going to make Stripe a pretty devastating competitor for Adyen and all of the other large and small payment service providers. I mean, not game over, but wow. I mean, it's almost getting to the point where you say, is there a competitive concern here that Stripe becomes too big? And I know that sounds daft, for a company that's only 20 years old, but could Stripe get too big with PayPal?
I think it's a great question. And if you go back again, like over the past decade, where we were seeing mergers or acquisitions in this space, it tended to be like the established incumbents trying to sort of accelerate their development, so whether that's banks or others trying to sort of then snap up fintechs. And this is real sort of proof of that sort of transition that, the likes of PayPal, Stripe have become the incumbents over the past 15 years and reached the scale. And I think payments is a challenging sector in terms of, ultimately the margins are fine and, increasingly fine, and you have more competition, the margins. So it becomes, obviously a volume play. And, we saw that at Klarna, really to get it to work, it needed economies of scale. And I think, that will be part of, I'd guess, the investment sort of hypothesis that would be happening here around merger is that, yes, you get the huge customer base, but again, the economies of scale. And I think that does then drive barriers to competition that others just can't get near to that kind of scale and that shared cost base to compete with whether it's the breadth of the offer, the global reach of the offer, the ease of integration of the offer. So I think it does make for to Danielle's point, I think it does the right activity underpinning sort of post-merger a real competitive advantage essentially.
Alberto, you talked about Stripe potentially wanting PayPal's customers and its reach and so on. Could there be other angles in here around the merchant relationships, the data, the network effects, or is there even an AI angle here? Is this potentially an agentic commerce play that PayPal maybe's got some capabilities that Stripe wants that will make it easier for Stripe to support agentic commerce, or am I just speculating wildly here? What do you think?
I mean, could be. I think essentially it's customer network effects, but obviously, the more data that you have, the more things you can do with AI, right? Now, Stripe owns the data on the businesses, but if it complements that with data from customers, I think they could really, really understand customer behaviors here and market dynamics, and that could maybe give them an edge, as you were saying, on AI capabilities. So potentially, that's my take.
Danielle, last quick question to you on this. We're seeing sort of growing consolidation among fintechs as the bigger fintechs now start to sort of pick up the smaller fintechs. As the bigger fintechs have got scale, as they've got sort of profitability, they've got the capacity to acquire small fintechs that often have great technology, great people, but maybe haven't hit the scale. Do you think that's a good thing for customers? That as sort of fintech companies come broader and bigger, is that good? Or do you think customers ultimately lose out from the consolidation? Obviously, it's good for shareholders. And
Sure. Great question. I believe it honestly depends on the motivation of the acquisition. So if the motivation of the acquisition was purely technology-based and looking to gain those additional capabilities and increase revenue, then obviously the customer experience is not going to be paramount. But if you have an experience or an acquisition where that is one of the main concerns and customer retention is leading the way, then it can be. Obviously, when they're acquiring these companies, they're going to want to retain the customer base. And it's interesting to see how they roll this out after they've done the initial merge. So I think it can be, but it definitely needs to be part of the roadmap, both in terms for customers, but also in terms for employees. When companies and cultures are merged, it's important that that is handled carefully as well. I've seen through some of these mergers, a lot of the companies lose that identity, which then trickles down to the customer experience and leads to customer churn. So it's exciting to see for sure, but definitely needs to be an awareness of the chief customer officer or whoever is monitoring the churn ratios there.
Yeah, it's a really, really exciting deal. All right. Well, I suspect we will be talking about this more on the podcast if this deal does indeed go ahead. Let's move forward to our next story, which is that buy now, pay later is entering a new regulatory era in the UK, because after years of consultation, the UK's new regulatory regime for buy now, pay later has come into force. The market has grown rapidly over the past decade, with more than 10 million British adults now using buy now, pay later, BNPL. Under the new rules, providers need to meet the Financial Conduct Authority's standards around affordability checks, transparency, and customer support, while customers in return gain access to the Financial Ombudsman service if something goes wrong. People in the industry have broadly welcomed the move, saying it should create greater consistency and confidence in the market. But some consumer groups have also warned that stricter affordability checks could make it harder for some people to access short-term credit, potentially pushing them to more expensive alternatives. Alex, so the UK has been talking about regulating BNPL for years. It's finally here. Hooray. What does this change?
What does it change? I mean, it's definitely a sort of a new chapter, I think, in terms of we have been talking about this for years. I went back through my notes, Benjamin. So I think I was on this podcast for episode 488, episode 708, and here I am for episode 1082, all 3 times at some stage talking about buy now, pay later regulation. So I think that gives a sense for how many years we've been talking about this. Like, ultimately, what does this change? Fundamentally, it raises standards across providers, which is important and good. It does weed out sort of bad actors and, sets a level in terms of authorisation that providers are required to have. But I think more importantly than for consumers, it brings additional protections. I think as a sector, because the rollout of regulation has taken so long, many of the issues have to a certain extent self-solved around whether that's how it's promoted, financial promotions, or whether it's affordability checks. Many providers have started to get ahead of that, frankly. That said, there were protections like, can I complain to the ombudsman if things go wrong? What happens if the goods aren't provided by the the retailer, or they're defective and they won't honour a warranty? Section 75 protections that come with, for example, using a credit card. Those additional protections that providers couldn't give to consumers, this does then enshrine those through regulation, which I think is a great thing. And, when I was at Klarna, there were lots of things we could do proactively. There were things which we were very clear that they were outside our gift to do or to emulate. And that now that's in place, which I think is a fab thing. I think the thing that's has to be a sort of a learning though, just up front, is it's taken, I went back through my notes. So I spoke with, Chris Willard and his team back in autumn of 2020 when they kicked off their review, and the findings then came out in early 2021. And that called for, and let's remind ourselves, the urgent need to regulate this sector. I don't think it's a particularly strong reflection of our sort of political, regulatory, policy-making landscape that, even at that stage, most of the providers were saying, look, we're supportive of this. It has then taken, the best part of 5 years to get to a point of giving those pretty basic protections to consumers that they would have had if they got a personal loan, if they'd got, used a credit card for that same, financing.
No, you're right. And it doesn't bode that well because effectively sort of buy now, pay later sort of slipped through a little bit of a gap in the regulations that nobody quite anticipated the product before it was invented. If we think about a world with AI where there's all sorts of incredibly powerful capabilities driving through giant holes because nobody envisaged that writing other regulations 10, 15, 20 years ago, it does raise a really serious question for regulators, not just in the UK, but all around the world about, well, if it's going to take you 5 years to regulate something, the current approaches to regulations potentially break. Danielle, I don't want to throw that to you because that's too big a question, but what do you make of this story? Do you think Alex is right that 5 years for really what we should have been quite a straightforward piece of regulation is just too long?
I completely agree. And particularly when you look at it from an AI perspective, we are at Sumsub working to fight against AI every day. And when you look at how convincing the scams and frauds through AI can become just over a period of 3 to 6 months, the 5-year time period is terrifying because these scams are becoming so much more sophisticated and coordinated. And as you mentioned, it definitely slipped through a gap, this buy now, pay later. And it's difficult because this regulation needs to be able to put the security measures in place, but we also need to ensure that people are able to get access to this credit fairly easily, but also weeding out the bad actors and the fraudsters, which are ever changing. It's a constant moving feast in this particular area. So I in America look at whatever Europe's doing and think, okay, we're a few years behind you. We have this regulation coming. But I'm a little bit in shock that it took 5 years. Legislation is never fast.
Alberto, what's your view on this story?
Well, I think that technology may allow to maximize the reach of this product, right? Because as you were mentioning, some consumers were concerned about the access to credit and then being pushed to other alternatives. I think that technology here is enabler, and that the goal isn't to make lending faster, it's to make better decisions, right? So historically, lenders had a trade-off: approving more people and losing more money, or rejecting more people and staying safe. I think that technology will help maximize the sample size of people that you can lend to more safely and reduce the false positives, right, of the people that you don't want to lend to.
Yeah, that's always the conundrum, isn't it? For any kind of lender, is if you sort of loosen your guidelines a little bit, and you lend to a few more people, you increase the risk of losses. You increase the risk of lending to people who can't pay it back. You also, of course, increase the risk of lending to people who never intend to pay it back. I mean, that's one of the challenges in any lending market is you've got both good, honest people who either miscalculate what they can afford to pay back, or more likely get hit by some life event, some illness, something happening in their life that means that suddenly something they could have done they can't do because they've lost their job or something bad has happened or whatever. Alex, these affordability concerns that some sort of consumer groups have raised, I mean, it's a tricky one, isn't it? Because obviously people who do get turned down by banks and building societies might get turned down by buy now, pay later providers on affordability checks. I suppose some of them may get driven to loan sharks or whatever, and that is a bad outcome. But is there any fix to that?
I mean, I think so. Just to be clear, I've always been told off for saying it was too slow buy now, pay later regulation. I probably should have said that up front. So whenever I used to say this has been too slow, and I'd always get told off by policymakers or politicians, and there's been a global pandemic in there, and we've had 5 different chancellors and maybe 7 different city ministers, etc. But I think And as part of that it takes time. We shouldn't underestimate that there is complexity in areas like this. So in terms of getting that regulation right, unintended consequences of regulation. So again, if you look for another sort of different but same sector, same broad sector of consumer credit, and you look to regulation of high cost credit in terms of Wonga type credit, payday lending, and the unintended consequence there of basically a sector that through regulation was closed. And again, lots of reporting subsequent to the event, a sort of beauty of hindsight to say where did these consumers go, and whether that's using illegal lenders, familial or friend lending, which sounds great on paper but often can lead to broken relationships and real challenges. I think some sympathy to regulators when you're and policymakers when you're trying to develop, for example, buy now pay later regulation, that you think about those unintended consequences up front, you lean into those, and you seek to mitigate. Now, the point on buy now pay later, particularly to affordability, which was always a challenge, and I think back to my time at Klarna, was that we could do great underwriting, we could look at their credit file, we could use open banking data to a certain extent, but there was increasingly a challenge around visibility of use of other providers. And so, it could be the hour before they used Klarna to get, for a purchase, they've used ClearPay. And then when we suddenly had that situation, by 2022, 2023, where there'd be 5 or 6 different buy now, pay later providers on that e-commerce site checkout, there's a real potential that a consumer over the space of 24 hours could have used all of them. We just wouldn't have visibility that had happened. They might not even had a payment come out from any of those other purchases yet to even see it in open banking data. So I think suddenly your decisions around affordability is sort of simplistic of looked at your income, looked at your outgoings, maybe looked at your credit file that is 8 weeks out of date. Just didn't marry up to this nature of this product. Now, I think the challenge as to how do you respond to that as providers is a lot of those barriers still haven't changed. We still have I have a lot of sympathy for credit reference agencies, but the ability to get real-time view of use of credit products, there is a delay, and I think a lot of those challenges are still there. So as a provider, what do you do? I'm seeing it as Facebook forums today exploding with chat about people's credit limits being reduced from buy now pay later providers, because I think providers are in a situation where they're probably having to be overly conservative right now to make sure they're not exposed to whether that's regulatory action, whether it's ombudsman complaints, whether it's complaints from CMCs. And so I think that is, and that's what I think, Fair for All issued some really interesting research looking at potentially 3 million people who might have been approved last week for buy now pay later, this week might be declined. And where do they go? So I think there's going to be a period of time where that needs to settle, and providers need to be confident that they're not exposed, for example, to CMC claims and complaints to the ombudsman, so that they can potentially get to a more proportionate view in terms of affordability assessment.
That is a lot of people. Alberto, that problem Alex is just describing of not always being able to see whether someone has just borrowed from another lender, in the last 5 minutes or in the last couple of days and so on. That sounds a little bit like a problem that AI and technology and data feeds and so on could help with, not necessarily fix, but you seeing any, and I realize you're not an expert in this necessarily, but are you seeing any sort of solutions in Spain or other markets where companies are trying to tackle that issue about sort of credit risk?
I certainly haven't seen those kind of solutions, but I don't think it's technology itself. I think it's having access to better data, and data that it's in time, right? As Alex was mentioning. So we don't have those visibility gaps for a couple hours. So I think having a shared system where institutions can share data freely, and real-time data more specifically would help. And then once we have a proper system of data, then AI maybe can help move the needle and find the data that matters. I don't know if that makes sense.
Yeah, no, that makes a lot of sense. Also, I want to just add on to Alex's comment about the sort of the regulators and the speed of regulation. I think, I have a huge amount of sympathy for regulators. It's incredibly difficult developing good regulations quickly. Hindsight's a wonderful thing. You can always see afterwards the sort of problems that should have been seen. But one thing struck me as you were talking about the delays and the changes in prime ministers and city ministers and chancellors of the exchequer and so on. And that happens, of course, in many countries, not just the UK, is that actually it feels a bit like the old sort of waterfall IT development where you're waiting for the big boss to approve it. And I think regulators and policymakers have got to take on the same lessons that the tech industry and fintech have taken on of you can't always wait for the man at the top or the woman at the top to approve things. You've got to, in order to move regulation more quickly, you've again got to sort of delegate it down closer to the sort of customer or closer to the point of return. Otherwise, it simply won't be fast enough. Anyway, that's a conversation for another podcast, I think. All right, we will take a quick pause here and we will be back very shortly. Before we get back to the news, we have some news of our own. We've just announced our latest After Dark event and tickets are available now. Join us at London's Village Underground on Wednesday the 17th of September for a live recording of Fintech Insider News. Head to 11fs.com/afterdark to claim your free ticket today. We'll put a link in the description below. Back to the news. Our next story this week is that Nubank has received banking authorization in Mexico. Nubank has received final authorization from the Mexican regulators to begin operating as a fully licensed bank, completing its transition from a popular financial society to a regulated banking institution. The Brazilian bank already serves more than 15 million customers in Mexico, making it the country's largest digital bank. It says the new license will allow it to expand its product offering while deepening its long-term investment in the market. The move is part of a broader strategy. Nubank has already established banking operations in Brazil, Mexico, and Colombia, and earlier this year received conditional approval to establish a national bank in the United States. Alberto, Nubank's a little bit like Stripe. It's one of these incredibly impressive fintech companies. What do you think getting a license in Mexico says about the evolution of Nubank?
I think it's a wonderful news for the industry. Especially in Mexico, we see a lot of foreign banks, and I'm not surprised that Nubank decided to apply for a license there because they had already entered the market previously, and they had like over 50 million customers in Mexico. They had captured like 6 billion in deposits, and as I'm aware, and the latest news, I think they've reached break even in this Q1 of 2026. So before receiving the license. So I think what this milestone says about the company is that it's not only growing and in Brazil, where it has become like a very relevant institution. Now it wants to become a very relevant institution outside of Brazil as well. And Mexico could be their new like flagship or second branch or biggest largest business line, right? And I think that's what they're after. A very large market, very interesting, and obviously a big milestone for the company.
It is a big market. It's easy to sort of not realize just how many Mexicans there are. I mean, 15 million is a huge number of customers, but it's only 10% of Mexicans, right? So, there's there's a lot of room for growth there. Alex, Nubank is hardly the first fintech to seek a banking license, and of course, this is not its first banking license. Why do you think we're seeing so many fintechs going for banking licenses? Revolut, Monzo, Klarna, Nubank. Just name 30 fintechs. They've all, not all, huge numbers of fintechs have gone for banking licenses. What drives that? What does having a banking license enable a new bank to do in Mexico that perhaps it couldn't do without the banking license?
Yeah, I mean, I think it's part of this sort of broader sort of journey, I suppose, you've seen over the last 15 years of fintechs. I think originally you had, the established banks as a sort of hub and spoke model with all these sort of satellites of capability that, fed off that, say, core current account, which kind of held you in. And then, in theory, you could then upsell, credit cards, you could personal loans, insurance, mortgages, you name it. And then I think what started to then happen with fintechs is they started to then pick off these sort of satellite capabilities. And they'd sort of like, we actually could do the lending better than you, or we can provide, credit cards with more benefits, or we can provide, cheaper foreign exchange, as we saw sort of where Revolut started. And then bit by bit, they started to sort of build that, ecosystem of capabilities. And then this is sort of almost like endgame territory. This is where they're coming into the hub now. And they're like, right, we've kind of proven this capability. We've acquired customers. They love us. And now we're coming for the current account, sort of the last sort of defense, I suppose, if you thought about it from like a medieval castle. So that is basically what we're seeing. Now, why do they want to come into the hub, I suppose? And I think the reality is that really is like the core, I suppose, of a lot of our financial relationships. And a lot of the challenge you're seeing with fintechs is there enough, whether it's profitability or scale that you can get with these satellite capabilities around the edge. And when I think back to my time at Klarna, like a lot of what we were doing there is these satellite capabilities, a bit like Nubank then in Mexico. It's a great way to build a customer base quickly and loyal. So, they come in with a lower barrier to entry through a credit card, for example, in Mexico. You build up this great offer, beautiful app. Customers get used to it. They're using your services. It's so organic then just to open up another tab in the app, which is your current account, move across all these lovely benefits that you can get. And they've got, they've essentially day one got that customer base to move across. Now, the alternative model of trying to do a bank from scratch, the barriers are so high the other way around. To build up that customer base, the cost, just to get your, we saw with Revolut the time it took them to get their permission, banking license in the UK. Like that route is hard if you did that purely as your sort of entry route. So I think this really is that sort of fintech playbook that you're seeing more and more now, which is you build up customer base, you build up loyalty with a collection of services, and you go for the hub, and then you get that share of wallet. You get then actually with that sort of profitability, you can then get the profitability that you need that comes from more than just doing a buy now pay later transaction every few months. You're suddenly really in the heart of how they live their lives.
Thank you.
Can I add a little something on that? I thought it was very interesting that New didn't look to fight the regulator at all. So they spent over a year looking to turn this fintech app into a licensed bank. And the scale of this is striking because they have a very deliberate regulatory journey, and they're demonstrating that they can have this value proposition at scale. So they had the lighter touch, I believe it was the SOF IPO license before they had their full banking powers. So when their approval comes in 2025, they're then able to go through this very rigorous regulatory audit before their authorization landed a few days ago. So this is incredibly strategic and shows the future of fintechs. For fintechs to evolve in this way and to become a fully fledged bank, the key is really having that long-term partnership with the regulators.
There was another question I was going to ask you as well, Danielle, because it's really easy to sort of sit here and talk about international expansion. And in theory, it sounds really easy. What are some of the practical difficulties of actually trying to expand a sort of fintech business from one country into one or more other countries? What are some of the biggest challenges?
Yeah, absolutely. That's something that I'm living every single day. So it's in terms of regulations, as we've mentioned, but there's also the cultural differences. And I really don't think that those can be understated. When you think just in North America, for example, the cultural differences that you can have from state to state, customer expectations will really, really differ. It's exactly the same when you look at countries in Latin America. So there's that. There's also the connections that people have to local government entities, the ability to influence legislation. These are all key components that are going to go into international expansion, as well as when you think of what, for example, Sumsub does, the ability to provide the services in region, to provide the business support. You're going to need employees that are within the region. This is all part of the focus. It needs to be international expansion. As you said, it's not just putting things on a PowerPoint and saying this is our goal for the next 12 to 18 months. You need to really break down what does this look like for day to day.
Thank you. Alberto, I was going to ask you a question about sort of technology and sort of understanding local customers and so on, but there's apparently quite a big football competition on at the moment. And I'm struck by the parallel between Nubank, this the Latin American champion, and Revolut, the sort of European champion. We've got these two digital banks, converging on the United States, looking to be, become sort of one of the world's most successful digital banks. So, hard question, Nubank or Revolut, which is going to be more successful? Easy question, and we're recording this before the World Cup final, Spain or Argentina for the win?
I think that's an easy one. I think Spain for sure. But, we'll see on Sunday. I'm Spanish, so I'm obviously biased. and on the first question, I think that's harder. I think that it really depends on the market. I don't know if I don't know which one will win. Probably both, because the market is large enough, and we've got literally thousands of banks worldwide, and I think that there's enough space for both of them, right? Probably new will be more popular in America in general. That would be my bet.
It's tempting to think that the sort of large sort of Latina population in the United States will be attracted to Nubank, but I hesitate ever to underestimate Revolut either. So
it's hard to tell, as you can.
But maybe actually, to Danielle's point, it's going to come down to partly how successfully those two firms negotiate the American regulators to sort of get approval. Okay, let's move on to our final big story of the week, which is that a survey by Sumsub shows that AI is changing the fraud landscape. So artificial intelligence is making financial scams more convincing than ever, as I'm sure everyone listening realizes. And new research finds that older consumers are among the most exposed. So the survey from verification platform Sumsub has found that almost 1 in 3 Americans over the age of 55 have been targeted by a scam over the past year. And only 1 in 5 of these American seniors believe that they could identify an AI-generated cloned voice, far fewer than among young Americans aged 18 to 24. And the findings come as the FBI, Federal Bureau of Investigations, reports receiving more than 22,000 AI-related fraud complaints last year, representing almost $900 million in reported losses. And the research also highlights another challenge, which is that many families still haven't discussed how they would respond if someone received an AI-generated phone call, video, or message pretending to be a loved one. Danielle, this is really interesting research, and it shows the biggest challenge isn't just the increasing sophistication, it's also that people aren't really prepared for it. What stood out most to you from the research?
Absolutely. What stood out to me is how quickly the scams are evolving. So AI has definitely lowered the barrier to creating very convincing scams, whether it's a clone voice, a realistic email, a text, or a fake customer service interaction. So the tools are becoming so much more accessible, and it's very difficult for people to rely on traditional warning signs. So awareness isn't enough anymore. I myself have been in this industry for a number of years, and I was nearly caught twice in the last 6 months. And this is a field I work in every day. I nearly was caught by a phone provider and also on a local Facebook group. So the scams have become so sophisticated that people need to have very simple verification habits that they can use if something feels urgent or unusual. And I think one of the points you mentioned is key. It almost needs to become part of the family safety. I remember when I was a child and my father would take me out in public, there was a code word. If somebody said, oh, my parents, I know your parents, they asked me to pick you up from school or something. And, if they didn't know the word banana, then I knew they were an imposter. But we do need to have that preventative step because it has become so convincing, and it's not just through banking, finance apps and things like that. It is through all areas of life, right? Through social media, through people attempting to purchase something on perhaps a Facebook marketplace. It's become incredibly sophisticated. So that really stood out to us. And one of the areas that really concern us is voice cloning, because it has such an ability to create a sense of urgency. If it sounds like a loved one, think how you feel in the moment. It plays on your emotions, and it's that familiarity that's very, very difficult to question. So that's definitely some very concerning developments that we're seeing, and we're constantly looking to fight them at what we do.
It's really interesting what you're saying, isn't it? Because it sort of takes you off guard, because this fraud will appear in familiar places, as you say, like a Facebook group or WhatsApp group or something like that. One of the things I was quite surprised by is actually not that the older Americans didn't think they could spot it, but that how many of the younger Americans think they can. And now, obviously, younger consumers generally a little bit more tech savvy, or a lot more tech savvy, actually. Alberto, does that surprise you that you've got like, 3/5 of young Americans saying, oh yeah, I can identify an AI-generated cloned voice? I mean, really? Can you? I mean, obviously, you're not in that age group yourself, but do you think young consumers are actually being overconfident here?
I think they're being extremely overconfident. And as we've seen in the past 24 months, this technology keeps getting better every day. So I wouldn't be so sure if, anyone can get tricked by this technology, right? So I think that authenticity won't come from human judgment or from like the technology that we have nowadays. It comes from verification systems. And what I'm thinking is that perhaps now it's the time for blockchain technology, because it allows real-time verification systems to work properly, right? And if we only rely on traditional technology checks or human judgment, I think that we're going to get tricked very, very easily.
It is interesting, the sort of attack factor that Danielle is suggesting of a voice call with a fake voice of a close relative saying, "Oh, I need, I'm in trouble. I need that." It was interesting because when you started talking about verification, Alberto, I thought you were going to say actually, families need to have some kind of verification, like the banana trick that Danielle was saying. Because is it realistic for families to put in place sort of some kind of blockchain-based system? I mean, how long will that take to roll out?
That's a good question. I was thinking with the blockchain thing, I was thinking more about the relationship between financial institutions and the regular customer, right? But between peers, I think it's going to be super complicated. I honestly don't have an answer on how we're going to solve that. But yeah, I mean, Danielle's point is super valid and good. Maybe these kind of internal rules that we set can really help us.
I think it goes back as well to what we saw with the being refused for the buy now, pay later, and then people falling, I'm going to use the word victim, to perhaps more predatory lending. There's that underlying behavior in humans of shame. So there's the shame of I've been refused for a more legitimate loan, and I've also fallen for a scam. And I think from what we see, particularly on a personal level, a lot of people don't want to talk about it, or they don't want to believe that they would be silly enough to fall victim to it. And there is a need, I believe, across society to remove the shame from this. These have become incredibly complex phishing schemes. This is not the scams that we saw 5-10 years ago of a prince from Nigeria saying, wire me your bank details, I'm going to send you $10 million. This is somebody calling you up, I found your dog, because they've seen that your dog was missing in a local Facebook group. Please, can you just verify you're the dog's owner? Before you know it, you've replied to a text because they're playing on that human emotion. So the takeaway that we really see on a personal level and across financial institutions and in fintechs and so on that they need to put in across blockchain, however that looks, is people shouldn't wait. This is now part of daily life. We shouldn't wait for something to happen to decide how you're going to respond. If you have that plan in place, whether it's in your family, whether it's with your financial accounts, then you're going to be able to have that clear mind to make a difference and make a decision when your emotions are running very high and someone is trying to pressure you into acting very quickly.
Alex, do you think there's anything that financial providers can do to help protect their customers from these types of scams? I mean, as Danielle says, they're becoming ever more sophisticated. Do you think there's anything financial firms can do to help protect their customers?
I think there's probably, from a consumer side, probably more tolerance now to high levels of friction than maybe there would have been a couple of years ago, because there is some level of awareness about the level of fraud, or everyone now has some story or experience of it where, even again, a couple of years ago, if you were like, you want to make a payment on an e-commerce site and then you're getting locked on a page saying you've got to approve the payment back in your own banking app, and you're like, oh, I've got to go get on the phone and go into this app and prove it. I think now, actually, look, I was probably one of those people complaining about that 2 years ago. Right now, I'd happily have that over experiences of either approving payments or buying something on a fraudulent, checkout without having had those checks. So I think there is a responsibility on providers to have sort of an appropriate level of, of friction to provide those checks. And again, I get irritated myself. I sound very irritable, but I get irritated myself when I buy anything where it's like, with HSBC, it's like pages every time I make a payment. It's like, you're 100%. 100 and 120% happy to be making this payment to so-and-so, and do you know exactly what it's for? Like, oh, just let me make the payment. But I think that extra level of like prompting you to think, question, maybe do your own phone call. I mean, to Danielle's point about shame, I remember, this is, a good few years ago, but like, I've been in days and days of WhatsApp chat with who I thought was Sebastian from Klarna, founder of Klarna. We had each other's number, I would have been messaged, but this went on for days until finally it made some strange thing about approving a payment. And then I suddenly was like, I had to contact, security team and be like, I'm really embarrassed, but I've basically been having a chat with a phantom fraudster for days now, thinking it was Sebastian on WhatsApp, totally embarrassed. And I think that happens like day in, day out, and people make stupid mistakes and they don't talk about it. So I think, having a level of suspicion ourselves as consumers, but that level of friction from providers to make us stop and think is important. Look, another part I'll throw in is, we always had this, again, back to times at Klarna, where we saw the parallels where we had very high levels of fraud in the UK. The team back in Stockholm couldn't understand this because they had, essentially digital ID through bank ID there that was providing an extra level of protection that was preventing this in terms of you could identifiers. So I think there are, as much as we don't like that sort of big brother, big mother, big sister model of digital ID in the UK, I think we do need to, it's a trade-off ultimately, isn't it, as to what the protection that could give you as one, extra tool in the toolkit to protect us from fraud. Last bit I would just say is like the AI piece, it is scary because the barriers to emulate, to Danielle's point, a crappy email was very easy to do, but the barriers now to emulate whole websites that are completely fake, the ability to emulate chat and agentic AI use to be doing a bit like that WhatsApp conversation I was having, but be doing that across thousands of people simultaneously with no human intervention is scary. So I think that, again, that extra bit of friction to provide a barrier, I think, is realistically right now one of the relatively, limited protections that financial service institutions, need to do.
Thank you. You make a great point about backing up Danielle's point about needing to take away the shame of getting caught out. So, thank you for admitting that, you, like so many of us, have been caught out. I think, Danielle, thank you for bringing us a really, really important story that everyone really needs to think about. So on that note, we will take a quick pause here and we will be back very shortly.
If you're a QuickBooks customer looking to grow without the growing pains, you need the Intuit ERP, the AI-native ERP that upgrades right from QuickBooks. Learn more at intuit.com/ERP.
Okay, now for a quick look at a story we don't have time to cover in full. which is that GoCardless and Sage have expanded their partnership to launch Pay by Bank for small and medium businesses. So GoCardless and Sage have expanded their long-standing partnership to bring Pay by Bank directly into Sage Business Cloud Accounting for small businesses in the UK and Ireland. The new integration allows businesses to accept instant account-to-account payments directly from invoicings, while automatically reconciling those payments within Sage. The companies say that this can reduce transaction costs by more than 50% compared with card payments, while helping businesses get paid faster and spend less time on manual bookkeeping. The announcement is another example of open banking moving beyond consumer use cases and becoming embedded into the software businesses use every day. Rather than asking small businesses to adopt a new payment method, Pay by Bank is being built directly into existing accounting workflows. Now, we asked Tom Metcalfe, Director of Global Partnerships at GoCardless, for his perspective, and he told us this. So let's have a listen.
We've just expanded our partnership with Sage, bringing Pay by Bank directly into Sage Business Cloud Accounting. That's a big win for over 20,000 small businesses across the UK and Ireland, giving them a simple, card-free way to settle invoices. Instead of paying high card fees, merchants now get paid in one business day, saving an average of 54% on transaction costs, and payments automatically reconciling in their accounts. Now, this ties into a much bigger story, and is one we're genuinely excited about here at GoCardless. Pay by Bank is a type of account-to-account payment, and that category got a huge boost in June when the UK Payments Initiative, or UKPI, launched its new Pay by Bank scheme. That supports the UK's national payment vision, which is all about driving more competition, more innovation, and more resilience by getting A2A payments adopted more widely. And that changes the bigger picture. For decades, UK businesses haven't had a real affordable domestic alternative to Visa and MasterCard. That near duopoly has cost the UK businesses an estimated £1.5 billion a year in fees. Pay by Bank changes that. And by building independent domestic account-to-account rails, we're helping the UK keep control over its financial infrastructure.
So my view is that this is a great example of where open banking works. People adopt payment systems when they're better than the existing alternatives. And financial transactions like payments between businesses are a really great example of this. Because when you look at alternatives like credit card payments, obviously there are fees associated with those. And those fees often go to things like reward schemes or payment systems working internationally, and various types of consumer protection and refund mechanisms, things that people take for granted until the payment doesn't necessarily work. But it means that credit cards can be relatively expensive for high-value financial transactions. So making it easy to do pay-by-bank payments within business-to-business systems is a really obvious and strong use case for open banking payments, particularly when you embed those payments and make the reconciliation easier. So this is a really smart move by Sage and GoCardless, and I expect to see this being quite successful, depending on exactly how the customer experience works and exactly how it's implemented. But I think this is a very smart move, and is the sort of area where we will see open banking payments and pay-by-bank payments being successful. And finally, a story that might make finding your next job a little bit less frustrating. The British government has launched a pay transparency consultation. The British government launched a consultation on plans to introduce greater pay transparency, including proposals that employers must publish salary ranges in job ads rather than waiting until later in the recruitment process. The consultation is part of a wider package of reforms aimed at tackling pay discrimination and making recruitment more transparent. Supporters argue it will help candidates make more informed decisions, reduce pay inequality, and create a fairer recruitment process. Others say it could make hiring more challenging and reduce flexibility during negotiations. So, obviously, there's a little bit of an interesting subject to discuss because the three of you are not necessarily looking for a new job, but I'm sure you know people who are looking for new jobs, and you've got former colleagues, friends, family members who've experienced the frustration of trying to find jobs. So let's talk about it in general terms. How do we think about, applying for jobs without knowing the salary? Alberto, if there's a job that's posted and there's no salary, Does that put you off? Does that put people off applying? Do you think that's a crucial piece of information, or is it okay? Hey, it's a super interesting job. I'll find out what the salary is.
I think it really depends on the point that you are in life at, right? And it really depends on the company and what you want to do, right? I'd say that having the salary up is always useful for the candidate, right? And also for the company, because it kind of helps you filter out the people that are interested versus the people that aren't, right? So yeah.
Yeah, I don't understand, honestly, why companies don't disclose salaries, because if you're a hiring manager and you don't disclose the salary, you get a bunch of candidates who are potentially overqualified who you can't afford, and you get a bunch of candidates who are underqualified who, to some extent, are wasting their own time. And it would be much kinder if you put the salary range in. That's going to rule out, candidates either side of it, candidates you can't afford and candidates who are probably not qualified. Danielle, do you think there's any good reason for companies not to publish salaries, at least for most jobs, salary ranges for most jobs?
Truthfully, no. And it's interesting living and working in the US, because we have the opposite in that we don't have a federal law that regulates that you have to declare this, but you do have patchwork of states such as Colorado, California, New Jersey that do have to declare the salary ranges when they put a job advertisement out. But that covers perhaps maybe a third of the workers in the United States. So for me, it comes down to trust and transparency. I do not see what the negative would be of doing a salary range, particularly perhaps not a specific figure, but a ballpark. As you mentioned, it ensures that you don't have people applying for the job that are wildly underqualified, but also people that are wildly overqualified, particularly if the job title is somewhat generic. But in today's day and age where it is very easy to access salary information with people sharing what they earn anonymously on platforms such as Reddit and Glassdoor, it doesn't seem to be a worthwhile practice. And to me, if I were to look for a new role and an organization wasn't sharing that openly, at least ballpark, or addressing it in the very first call, that would bring an issue of trust to me and transparency.
That's a really interesting point. Alex, do you agree that actually, the transparency is a sort of competitive advantage, and if you're not transparent, it starts putting candidates off?
Yes, I do. And I've seen both sides in different organizations that I've worked or roles that I've looked at. And there are organizations not disclosing salaries, and where I've had that experience and sort of understood their logic. Now, often it can come down to a negotiating tactic, and for me, that's not a big draw if I'm going to an organization. If even before you've got to that stage, trying to sort of play that down. The other side where I've seen it is where actually often it's symptomatic of where there's internal pay structure issues in the organization, and frankly, that's probably exposing more issues to them. I've seen that myself in organizations where hiring managers were nervous to disclose salary because they know they've got such a wide range of salaries that they're paying existing staff, and this will expose that even more so, and it becomes a sort of a hole that they just dig themselves deeper and deeper. Now, why do I like to have salary ranges? And even salary ranges, I prefer to try and get as specific as you can, is that so often it's a contributor to pay disparities between genders, between people from different socioeconomic backgrounds, for various other characteristics where people have different confidence levels as to how they want to then negotiate and sort of what they feel they're worth. And, I've seen that time and time again, particularly the gender disparity where, typically the male candidates will be like, absolutely, I'm at the top of the range. And often we've had, female candidates who are, much more accepting of a concept of you come in at this and you can work your way up. And, one of the things I was very proud of at Klarna was that sort of real push to have, absolute gender parity in terms of pay. And I think, non-disclosure of salaries or, wide salary ranges as a sort of proxy for that, often are contributors to that kind of unfair pay between, different groups.
Fantastic. A great way to wrap up that story and the show. Thank you so much to the three of you for joining me today. You've been absolutely fantastic. Where can people find out a little bit more about you and your companies? Danielle, where can people find out more about you and more about Sumsub?
Absolutely. So we are at sumsub.com, and I am on LinkedIn as Danielle Labarbera if anyone would like to connect with me.
Thank you. Alberto, where can people find out more about you and more about Dalatea?
So people can find out more about Dalatea on dalatea.com. And I'd also invite the audience to connect me on LinkedIn. I'm very active on the platform and try to post a lot of stuff on banking and banking regulation and banking risks. So yeah, that's it.
And Alex, where can people find out more about you and Salad Group?
So you can find out more about Salad Group at salad.co.uk. So there's a load of information on there. Please do have a read. For myself, I'm all about trying to get off channels if I can. I'm all about getting off social media, etc. But LinkedIn, you will find me on LinkedIn. Alex D.G. Marsh. There's a adult film actor called Alex Marsh, which has been a curse of my life. So I'm now very grateful for the David George that my parents bestowed on me as middle name. So yeah, Alex D.G. Marsh on LinkedIn. Please do connect.
And as for me, Benjamin Ensor, you can find me on LinkedIn and you can find out more about 11FS at 11FS.com. So that wraps up today's episode. Thank you so much for listening to today's show. If you like what you've heard, please do recommend us to friends or colleagues. And you can follow us on your favorite podcast platform of choice. So thank you all so much and goodbye.